Terry Smith, a famous British hedge fund manager, has done some massive moves in his portfolio, and the one that we want to draw your attention to today is he has added $30 million worth of Paycom Software, ticker symbol PAYC. Now, this is a company that is right there towards its 52-week low, and in today's episode, we're going to analyze this dividend company. It looks to be severely undervalued, and as always, we are going to look at this company in detail, their top line revenue growth, which has been extraordinary, as well as their bottom line net income. We're going to look at their balance sheet, the health, their cash versus their total debt, which is also very, very strong. We'll look towards both insider movements as well as institutional ownership, and we also want to run through their financial metrics. Now, it has just recently started paying a dividend, but there are a lot of underlining, like the free cash flow, like the ROIC, that we want to draw your attention to today. And as always, we're going to run it through the valuation model, getting to our intrinsic value, our acceptable buy price given our investor margin of safety, as well as looking at Wall Street's price target over the next 12 months, which is absolutely incredible. This is an episode you do not want to miss. So let's jump straight into the historical performance for those that are relatively new to this company. Paycom Software, as we can see, over the last year is down around 36%, but when we do expand it over the last 10 years, we do see this company up over 1,105%. We also note all-time highs sitting around $548, quite some way away from the current trading price. When we take a look at the rating summary, we have 3 hold ratings across the analysts. We do also note on a trailing 12-month basis, it does offer a yield of 0.86%, and in terms of a forward P, it does sit around 22.45, and not that far off the S&P 500 out of today's value. So in terms of this company, we want to do a deep dive. It does look incredibly undervalued. Total revenue, remember, year on year, we do want to see a minimum 3 to 7% growth. 151 million reported in December 2014, 1.79 billion reported, in fact, in December 2023. So we do know some very strong growth year on year, absolutely phenomenal. In fact, more than 10 times over the last 10 years. And when we take a look at the graphical basis, we can see over the longer term, this is a company that is rapidly increasing their top line. We're not going to go into their earnings into too much detail, but just 2 things that we do want to draw your attention to. The financial highlights for Q1 of 2024, they increased their top line by around 10.7%, so double digits. And when we do take a look at their full year guidance, for December 31st, 2024, the anticipation around 1.86 to 1.885 for the full year. So we can see it is expected to increase strongly into 2024 as well. So ticking off a lot of the right boxes at the moment, it is also near its 52-week low. In terms of the bottom line net income, well, firstly, on a graphical basis, we do see it, although slightly inconsistent, moving in the right direction, as we can see and love to see, in fact, with this company. 5.7 million in December 2014, 341 million in December 2023. So lots of growth, not just on the top line, but also the bottom line. And when we look at the balance sheet, very, very strong. They had 25.1 million of cash sitting on their balance sheet in December 2014, 371 in their latest quarterly report. And we can see over the longer term that cash has been growing year on year, which is a positive sign, but really we need to also see it and compare it to their total debt, numerically and directionally, as we always do. 27 billion of debt sitting on that balance sheet, and we notice in their latest quarterly report sitting at 0. So that is very, very strong. Whilst their cash has increased over the longer term, their total debt, as we can see year on year, very small regardless, but in that latest quarterly report, they do have no debt. So very, very positive, a very, very strong balance sheet as well. Another thing we like to look at is their earnings per share, past performance as well as future. What we can see already, their track record over the last 4 quarters, 100%. So they have beaten analyst targets every single quarter, Q2 23 all the way to Q1 24. However, when we do look at the next 4 quarters, we do see the anticipation on a year-on-year basis for the next 3 forward looking is low single digit decrease, although we can see Q1 of 2025 it is expected to pick up 8.57%. So something that we will need to factor into our margin of safety as well as our own investment thesis. One of the grades that we look at is the valuation aspect, and we do note it does get a D. Now there are many different ways that you can value the company, as you can see, lots of different metrics. The one that we focus on a high level, as we do cover a few in this episode, the P on a non-GAAP forward basis, 22.45. Now we do note the sector median does sit lower at 19.25, so you are paying a premium around 16.6% in correlation to others in the sector. Just bear in mind though that this isn't a very true metric of comparison, as you also need to understand whether the others are of a high quality as well. When we do move on then into the growth grade, they do get a C+. Few things to note from this and that I will draw your attention to. Year-on-year growth, 18.23%, significantly better than the sector median of 5.14. Revenue on a forward basis, 15.05%, significantly better than the sector median of 6.25. And we can see other metrics here. The one that maybe lets them down is the earnings per share on a forward basis. Over the next 3 to 5 years, it is expected it will increase 10% year on year, whilst we do in fact see the sector median a little bit higher at 12.1%. In fact, it is, in terms of percentages, lower by 14.42%. Now, there are a few other metrics if you do want to take a look at, but we can see in today's episode, overall it does get a C+, but the metrics that we did look at looked fairly strong in comparison to the sector. Now, profitability grade, an A-, but pretty much across the board we are looking at A+. Gross profit margin, very, very high, 86.55%, with the sector median 30.86%. Bottom line margin, 27%, sector median at 6%, so very strong. It is very understandable and justifiable why they have that A- grade. Another metric that we like to look at, the cash from operations, 487 million, with the sector around 309.75. So lots to like about this company. Again, you need to do your own due diligence, but from these metrics, it does look like we are off to a very good starting point. We do, however, note 3 hold ratings, as we discussed earlier, and in summarization, a valuation grade of a D, growth C+, and profitability A-. Now, how have they compared against others in the industry over the last 10 years? Well, in the human resources and employment services, we have Dayforce, Palo City Holding, Robert Half, as well as a few others. Now, over the last year, total return, so remember, including dividends reinvested, they are down 35%, making them the worst performer out of this bunch of competitors over a 12-month period. When we extend this to over the last 5 years, we do note again the worst performing, down 13.48%. When we expand it over the last 10 years, they are the best performing, as we can see here, 1,117%, even after the very poor performance they've had over the last year. If you were to zoom out, they have performed phenomenally well. As always though, this will depend at what point you have purchased shares, or if, for example, you are looking and this is on your watch list. One thing I would say is no matter how good, no matter how bad their performance has been, or any other companies over the past, do remember that it isn't an indicator of their future performance. Now let's get into some movement. So insider ownership, it does sit fairly high in comparison to others that we've reviewed on the channel, 12.6%, with 1 instant of insider buying over the last 12 months, 2 selling over the same period, around 50,000 worth of buys, 250,000 worth of sales. Now, to notice any of these, we do have to go to Q4, where we see insider buying of 50,000, and Q3 for insider selling of 130,000. Now, who are these insiders and individuals? Well, we can see the director on the 3rd of November 2023, so quite some way away, did buy over 300 shares, around $159 for 50,000 in total. Now, you can see the information. Personally, insider buying is a very bullish signal, as they do buy really for only one reason: they believe the share price will go up. But again, you could say it's a little bit outdated to include into your own investment thesis. We do also notice some insider selling, the more recent, in fact, the 8th of September 2023. So I would perhaps say this is a little bit too outdated to discuss and include. Now, when we take a look at institutional ownership, just under 88%, we see 1.45 billion worth of sales by the institutions over the last 12 months. We do see marginally a little bit more buying over the same time period, and when we do look at the latest quarter, again, we see marginal more buys than sells. So Overall, not just the last 12 months, but as well as Q1, so the latest period for the data we have, institutions have been buying more than selling. But please remember, always do your own due diligence. Whether or not you want to include this data into your investment analysis, that is up to you, but always do that separate to this look that we are doing today. Also, just to let you know, we have released our latest free weekly article where we run through 20 potential companies to add that are undervalued in the dividend area. Now, we also have other articles if you do want to read completely free by clicking on the pinned comment below. We also want to point out that this article here on how to find undervalued stocks, we do run through all the websites and resources we use on the channel. So if you do want to analyze companies side by side like us, you can look at those websites. Now let's jump into the dividend safety and the underlying metrics. As we mentioned, as they've just recently started to pay a dividend, we don't have a score right now. Market cap just under 10 billion. It is a mid-cap company. Now, what we notice when we take a look at their free cash flow payout, 23% in 2023, 29% expected in 2024, which is a very good sign. Essentially, it's below 30%. For us, in fact, below 60% does look very strong, giving us faith that they can offer those lovely double-digit dividend increases we love to see. So I'd be surprised if we don't see a very healthy increase from Paycom Software very soon. In terms of the free cash flow per share, very nice to see consistent increases over the longer term. We're talking 16 cents in 2014, $4.99 in 2023, $5.26 anticipated in 2024. So it's continuing to increase over the longer term. This is a very good sign for any company, not just Paycom, that you want to consider in your own portfolio, increasing free cash flows. Sales growth, well, again, very strong double digit every single year. We love to see this. Just their latest quarter up 11.7%. And while it is expected to slow down, as we can see 18% on a trailing 12-month basis, it is still very, very strong. But again, you can factor in the slowdown that we are seeing over the longer term. In terms of numericals, well, we did see this earlier on, so just a different format. And in terms of shares outstanding, one of the main things we like to see is companies doing those share buybacks, effectively returning that excess cash to investor pockets. We do know they would have diluted your position over the last 10 years, but they have also grown share price over 1,000%, so you probably wouldn't care. The other thing that we do want to point out, in fact, from 2016, they have been doing very, very small share buybacks. It's just the net position over the longer term is share dilution. In terms of ROIC, a very, very strong signal. Remember, 10% or more to give us faith that management are able to effectively allocate their capital. Looking phenomenal, 30% in 2023, 37% on the trailing 12-month basis. So this makes it incredibly attractive to investors, potential investors, and no surprises from the data we've seen as to why Terry Smith has been adding a significant amount to his portfolio. In terms of margins, well, two things to note. Well above the minimums that we want to see on the operating side, as well as operational efficiency. And on the free cash flow margin, very consistent in the teens, looking very, very healthy, 17% over the last 2 years. We then come on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. And remember, correlating with dividend safety, balance sheet strength, 0 over the last 5 years, expected 0 next year. Won't even take them 1 day to pay off all of that debt net of cash on hand. And no surprises there at all, given the fact their total debt from that latest quarter is 0. Absolutely phenomenal. Just on that, it should be something just to consider in the portfolio. So let's jump into the valuation model. As always, if you're enjoying the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's take a look at the multiples valuation, the first model, companies in the similar sector and size that we saw when we were comparing it over the last 10 years. We have the average P multiplied by the EPS of PAYC to get an intrinsic value here. Now we have a massive undervaluation signal with the intrinsic value of 284 over the market value of 175. Just bear in mind that we're not looking at any one of these models in isolation. Now, typically the dividend discount model would be the second model. They do pay a dividend. However, given they have just started to pay, it isn't, to be fair or relevant, to use this model just yet. Something we will incorporate into the evaluation model of Paycom at a later date. We then move on to their discounted cash flow model. We have the free cash flow year on year. Absolutely phenomenal growth over the last 10 years of 60%. We've gone a lot more conservative at 14%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, which is in fact 0. Gives us the equity value, divide by the shares outstanding, and we can see here another strong undervaluation signal. So the intrinsic value in today's episode is just purely the average of these two models. You can see coming to $256. Don't forget you can click on the pinned comment below to get to the valuation model if you want to run your own numbers through for whether it's a company of your own on your watch list, get to both the intrinsic value as well as the acceptable buy price. So margin of safety then, as always, we execute on 10% and we use that if we believe it meets 3 criteria. Wide moat, strong financial metrics, and good forward-looking data. If you believe that for PAYC, it is a buy up to $230, and then we keep going till it's near that current trading price, and we can see in today's episode some significant MOS, not at 35%, but we do see it pretty much around that 30% margin of safety based on that information we have gone through in today's episode. In terms of Wall Street and their forecast over the next 12 months, well, they do see this slightly lower than our intrinsic value, but a price target of $246.31, indicating upside of 41% to Paycom, and we can clearly see why Terry Smith has added around $30 million worth into the portfolio. Lots of strong metrics as we have gone through, increasing revenues, bottom line looking very healthy as well in line, balance sheet looking very strong, they have no debt, and when we have run through the ROICs, the operating, the free cash flow margins, this looks like a company definitely to consider for the portfolio or have it on the watch list so you can analyze it at a later date. As always though, do let us know your thoughts in the comments below. Is this one you are looking to buy? Maybe you've bought it recently as well. Maybe it's on the watch list, or for whatever reason, maybe it's one you do want to steer clear of. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button. As always, we'll see you on the next one, and take care for now.